US stocks just finished their worst first half since 1962.
That was a video I posted exactly 6 months ago, right smack dab in the middle of 2022. At the time, the S&P 500 was down 20% on the year. And I noted as bad as stocks had done in the first half of 2022, it didn't necessarily indicate anything about what would happen in the second half of the year. A negative return in the first half of the year is followed by a negative return in the second half of the year 50% of the time. It's basically a coin flip. So now the final results are in and the market actually ended up in the second half of the year. It's not much, but from the end of June through the end of December, the S&P 500 returned a positive 2.3%. So US stocks have essentially been treading water over the past 6 months. Now that doesn't mean that 2022 was a good year. On the contrary, the market still ended with an 18% loss for the full year, which is its first negative annual return since 2018 and its largest loss since 2008 when it dropped 37%. But I think a lot of people will look at 2022's 18% decline and be kind of relieved, because for everything that 2022 threw at investors, it could have been a heck of a lot worse. Inflation hit a 40-year high, interest rates went from 0 up to 4.5%, Russia invaded Ukraine, which sent commodity prices spiraling upwards, there was an energy crisis in Europe, the list goes on and on. 2022 felt a lot worse than it ended up being, at least when it comes to the most popular measure of the broad US stock market, the S&P 500. There were areas of the financial markets that were hit much harder than that index. For instance, the tech-heavy NASDAQ 100 fell by 32%, no thanks to massive declines in stocks like Alphabet, Amazon, Nvidia, Meta, and many others. If you look at former high flyers like the ARK Innovation ETF, cloud computing stocks, SPACs, meme stocks, and crypto, prices are down 50, 60, 70% or more, a total bloodbath. While you wouldn't know it by just looking at the S&P 500, behind the scenes an enormous asset price bubble was bursting, bringing those frothy parts of the market back down to earth. That bubble would have popped regardless of the macroeconomic situation, but I think it's fair to say that the bursting of the bubble was accelerated by the huge spike in interest rates that we saw this year. I talked about the Fed funds rate going from 0 to 4.5% this year, but we also saw the 10-year Treasury bond yield go from 1.5% up to 3.87%. The spike in bond yields led to a 13% decline in the Bloomberg US Aggregate Bond Index, its worst annual loss ever. Yes, believe it or not, this was the worst year for bonds in modern history. Prior to 2022, we hadn't seen a decline of more than 2.9%. So that's the story of markets in 2022. We got a shallow bear market in the broad US stock market, the COVID bubble popped, leading to huge losses in the frothy parts of the market, and we saw the worst decline in history for the US bond market. So a lot of investors will be happy to turn the page to 2023. But whether or not we see better returns in the new year is going to depend on the answers to some big open questions. Like, will the Fed be successful in bringing down inflation? Is the Fed close to the end of its rate hiking cycle, or will it have to push rates well beyond 5%? Can the US economy avoid a recession and a significant increase in the unemployment rate? Can corporations continue to grow their earnings in 2023? And what happens with major economies outside of the US, like in Europe and China? Fortunately, history is on the side of the bulls. Since 1950, a negative year in the S&P 500 has been followed by a positive year 80% of the time. That's not a guarantee that stocks will rise in 2023. There have been periods in which stocks fell in back-to-back years, but it's a comforting statistic. I'm keeping my fingers crossed that 2023 ends up being a better year than 2022 for investors. We'll see what happens. Subscribe for more investing insights.